Investors should be fearful when others are greedy and greedy when others are fearful. Get your pen and paper ready. But remember, if you're going to do dumb things when a stock goes down, then you shouldn't be owning stock at all. By the end of this episode, I will show you how to multiply or grow your money from $1,000. I don't have any money left over after the expenses because of the rising cost of living. Stay put. I'm going to show you how to work it out. We're going to cover the main things you have to know about SPY if you choose to invest. That is the dividends you may expect if you invest in SPY. We're also going to touch on the assets under management, which gives investors confidence whether or not to invest in a fund, the returns you can expect. The expense ratio, of course, there must be a cost aspect to every investment you have. You have to pay your taxes and whether this is good for retirement or not so. SPY is an exchange traded fund, in short ETF. It tracks the performance of the S&P 500 index, which represents 500 of the largest US companies across different sectors. Who owns SPY? SPY was originally introduced in 1993 and it is managed by State Street Global Advisors. So you can see more and more investors have confidence in SPY because from 2020, you look at the assets under management, it was just $330 billion. But as of September 2025, we are talking about $664 billion. So it's been a steady increase over time. So let's see which sectors SPY has invested in because this matters a lot. Always remember that sector concentration can introduce risk because if an industry cycle turns or if regulation or macro conditions affect big sectors, it means the performance of the fund will swing, okay, either up or down. So the top five sectors in SPY are IT, information technology, the financials, consumer discretionary, communication services, and healthcare. So what happens to those five big sectors will determine what happens or will dictate what happens to the fund. So the large sectors like technology, if it does really well, then SPY will benefit more. Okay, you'll see that the fund will be growing and you'll be getting good returns. But when large sectors, because of the weight of those sectors in the fund, when the large sectors decline, then SPY can suffer more because it has more exposure in those sectors. So as a beginner, just make sure you check the sectors in a particular fund before you invest, and that can help you to understand what is happening to the fund and what risks you're getting into. SPY is a unit investment trust, and it means that certain corporate actions are handled differently compared to other ETFs. Remember that SPY is the first ETF in the US market. But I want us to focus on the portfolio turnover. Now, SPY has a low portfolio turnover. What does portfolio turnover mean? Portfolio turnover means that it is the percentage of a fund's holdings that are bought and sold or replaced every year. And a high turnover means that the fund is frequently buying and selling its stocks. And you know that anytime that the fund is buying and selling its stocks, there are cost implications, okay? And there are taxes. So SPI has a low turnover, 3%. The fund hardly changes its holdings, so which means it is attractive to investors. There are other ETFs that have a portfolio turnover of even up to 70%. But today, let's just focus on SPY. What are the costs of investing in SPY? Remember, even small fees can reduce returns over time. And lower fees means more of your money stays investment. So you need to compare SPY's fee with other ETFs. I've covered other ETFs in different episodes like the IVV, the VOO, and I found that the expense ratio of SPY, which is 0.0945%, is the highest among the other ETFs I've covered. So you need to really do a good comparison because it will add up over the years. So other costs, apart from the expense ratio, the expense fees, the 0.0945%, the extra fees you also have to factor include the brokerage commissions. Which broker are you going to use? Later on, I'll cover just a small section about how to choose a good broker. So brokerage commissions, they cover like when you buy and sell, or when the account fees, maintaining the account, or even if you are buying SPY from a different company, the foreign transaction fees, you have to also cater for that. Then there's the bid ask spread. This is the difference between what buyers are willing to pay, the bid, and what sellers are asking for. They ask, okay, at a given moment. And a wider spread means losing more when you buy or sell. Now, note that SPY has very high liquidity, which means the bid ask spread is tight, okay? That helps reduce cost to some, at least to a good ratio. So all these costs that I've mentioned eat into your net return. So for small investors, you have to be particularly careful because over long periods, even small differences matter, especially when it is compounded. Well, past performance is not a guarantee of future returns, but at least just looking at the historical performance of SPY can help you to make judgment of whether or not you want to invest in SPY, because it can help you to do some simple calculations, as I'll show you towards the end of this episode. So SPY has given an average annual return of around 10 to 11%. But I want us to focus on the difference between total return and price return. When you see reports of returns, check whether they include dividends, and this means it is the total return. If it includes only the capital appreciation, it is the price return. SPY is generally better for long-term investors because the price will go up and down, okay? The risks smooth out over time, and also you're going to benefit from compounding. I'll expound more on whether you should invest in SPY on a long-term basis or on a short-term basis. Also, you need to know the YTD return. As of mid-September 2025, the YTD return from January 1st to date is around 13.3%. What is the tracking difference in SPY? But before I explain that, you need to have clarity on the difference between SPY and the S&P 500. So the S&P 500, often called S&P or SPX or SPX index, it is just a stock market index. It is not the same as SPY. Tracking error or tracking difference measures how closely the ETF's performance matches the performance of its benchmark, and which is the S&P 500 index. In simple terms, it can be defined as the standard deviation of the differences between the ETF's returns, SPY returns, and the index returns. Okay. So it's good to note that the smaller the tracking error, the more confident you can be that what you are investing in reflects what the index does. Because if you're investing in an index fund or ETF, you generally want the tracking error to be as small as possible because you are paying fees. Okay. You are dealing with timing, and all these things cause small deviations. So for SPY, the tracking error is very small, around 0.05%, and it is very large and liquid. Its tracking error is among the lowest you'll see in passive S&P 500 ETFs. All investments bear an element of risk. Because SPY mirrors the S&P 500, it has all the market risk of the large US companies. It goes up when most US stocks go up, and it goes down when the markets fall. Also, note the sector concentration matters. If the big sectors do poorly, SPY will be affected strongly. So knowing the risk helps you to decide how much of your money you're going to put into this type of investment and whether you can handle the big declines. So you have to be prepared on how you're going to handle the market risk because of the concentration of the US large cap markets in SPY, the concentration, the sector concentration, which we've covered, also the inflation, the rising rates. SPY pays dividends on a quarterly basis. The last dividend payment for quarter three, we are in September, was around $1.83. So the yield will vary depending on the underlying company's dividend payments, because SPY collects dividends from the companies in the S&P 500 and it will distribute them quarterly to its shareholders. But you have to note that SPY is not accumulating. That means the dividends are paid out. They are not reinvested automatically in the fund. So what you receive depends on how many shares you own. Earlier on in this episode, I mentioned that SPY is structured as a unit investment trust, which means it has some limitation. And one limitation is that the fund itself does not reinvest the dividends internally. It distributes them to shareholders. But we know that reinvesting improves compounding. So how can you reinvest dividends in SPY? There are two ways. One is manual reinvestment. When you receive the dividend payments, you use them to buy more shares of SPY or fractional shares if your broker allows. Through now that is through your brokerage. The second method is just turning on the dividend reinvestment plan. Some brokers offer the automated dividend reinvestment plan services where your dividends are automatically used to buy more shares or fractions of SPY. How liquid is SPY? And by liquidity, we mean how easily can you buy or sell SPY? SPY is very liquid. It is one of the most heavily traded ETFs in the world. Also, that means that it has tight bid ask spreads because of the high volume. So it's easy to enter or exit position. You won't be stuck whether you want to sell or to buy because there are lots of trades every day. For beginners, high liquidity means less risk of losing money just from the trading costs. If SPY was not liquid, you might buy high and sell low just because there are no enough people trading. But because it is very liquid, it is easy to enter and to exit. How is SPY taxed? Okay. And it's different for US investors and non US investors. If you're a US investor, you are subject to federal income tax on both the dividends SPY pays out and on any capital gains, okay, when you sell your shares at a profit. Now, note that for qualified dividends, you will enjoy a lower tax rate than the ordinary income, like 0%, 15%, 20%. It depends on your taxable income. And also, many of SPY's dividends are qualified, provided you meet the certain holding period requirements. I did another different episode on taxation. Now, if you hold SPY in a tax advantaged account like the Roth IRA, taxation is deferred or altered depending on the type of account. Also, you'll pay tax on capital gains. When you sell SPY, the profit you get, okay, the selling price minus your cost basis will be taxed. And if you held it for over 1 year, you'll be taxed at the long term capital gains rate. And if it is under 1 year, it will be ordinary income tax rates. For the non US investors, the US law requires a withholding tax on dividends. The standard rate is 30% of the dividend amount unless there's a tax treaty between the US and your country, okay? And that will reduce the rate. Secondly, if you are an US investor, you are not typically taxed by the US on capital gains from selling SPY shares if the gains are not connected with a US trade or business. That means for most passive foreign investors, simply holding SPY and selling later does not trigger a US capital gains tax. The company must be connected with a US trade or business for you to be required to pay the tax. Investors note that you will fill an IRS form so that the broker can know how much tax you're going to pay. You also have to take note of the currency conversion costs because it means if the dollar fluctuates, that will affect your returns, okay? Also, the broker fees and the transaction costs may be higher for if you're an international investor. So you need a broker that allows you to buy the US listed ETFs. So let's see, how do you select a good broker? One is the fees or commissions. Not too high, not too low, just at a good rate. Because remember, cheap is expensive. So understand why they are charging either high fees or what service you can get. Maybe there's good customer service, which is another thing you have to check on. You want a broker that will respond if you have any concerns or you have questions or you want to do something fast. You need a broker with a good response rate, okay? You also need a broker who can possibly offer you fractional shares because you may not be able to buy SPY at the price. Suppose the price is like $600, but you only want to invest $100 or less. It means you need the fractional share facility. So check if the broker can offer fractional shares. Also, the broker should be able to support you to fill the required tax forms that I've mentioned. And also, they should be able to access the US markets. Can you use SPY for short term trading? Yes, but be aware of the risks. One, the more frequent you trade, the higher your cost because of the commissions, the spread, and the taxes you have to pay. Two, you have to be so good in timing, and trying to time the market as a beginner, trying to time the market bottoms or tops is hard. You may miss out on gains if you sell early or get in late. There's the emotional stress that you may have to deal with because short term losses can be stressful. And remember, because SPY trades like a stock, the price can jump up and down so fast. So if you don't know how to handle all these things that can stress you as you're trading SPY, it is better to buy SPY and hold it for long periods so that you can benefit from compounding. What is the minimum amount I need to invest in SPY? There is no fixed universal minimum set by SPY itself as the fund, but in practice, the minimum depends on a lot of other things. Okay, one is that if the price of one share is 660, you need to buy at least one share unless your broker allows for fractional shares. Another thing you have to take into consideration are the brokerage requirements. Depending on the broker you choose, some brokers have minimum account sizes. So you have to ask about the minimum account size or the minimum deposit they demand or the minimum trade amounts or their commission fees. If you're an US investor, also currency conversion. You need to convert your local currency to US dollars and possibly you'll incur some fees. So many brokers allow for fractional share investing, meaning you can buy part of one share or for smaller amounts. And that these all these they lower the barrier to entry. That's why I was saying you can start with $100, you can start with $1,000 and build it up even up to $1 million. So let's see, what if you decide to do dollar cost averaging? Dollar cost averaging means you're going to invest a fixed amount of money into SPY at regular intervals. It may be weekly, it may be monthly, it may be quarterly, regardless of whether the price is high or low. So your goal is to reduce the risk of investing all your money at once by just spreading your purchases over time. So the steps are so simple. You just open your account with the broker that allows you to buy SPY. It may be Fidelity, it may be Vanguard, it may be Charles Schwab, it may be Robinhood, or whichever international broker you choose if you are outside the US. So ensure they offer the automatic investment plans or fractional shares because now we want to invest in small amounts. Then you decide on the contribution. For example, it may be $200 for every payment, okay, for every purchase you want to make. So that's the fixed amount you're going to invest, no matter what the price of SPY is. Make sure you buy SPY according to your schedule, okay? So set a calendar reminder. Just make sure you continue buying SPY and stay consistent. Over time, you'll buy SPY at different prices. Sometimes you'll buy when it is expensive, sometimes you'll buy it when it is cheap. So at the end of the day, it averages out your cost per share. Then also reinvest your dividends. You can turn on the dividend reinvestment plan if it is available. But is dollar cost averaging that good or there's a downside to it? Now, dollar cost averaging may lead to lower returns than lump sum investing, okay? If you had the full money available, investing it all at once in lump sum often will outperform dollar cost averaging because more of your money is exposed to growth earlier, okay? Also, you have to take into consideration higher transaction costs. If your broker charges commissions per trade, buying small amounts often can eat into your returns. So if you can get a broker who is commission free, maybe it. Finally, we've gotten to the sweet part where we can do our calculations. But before that, you need to know that there are alternatives to SPY, okay? Other ETFs that track the S&P 500 with different costs and features, like VOO, like IVV. So you have to compare things like the expense ratio, the liquidity, the broker costs. So it can help you to decide if SPY is right or not for you. So I've done different episodes. Check through my playlist. Also remember to like and subscribe so that when I post the next episode, you get a notification to continue learning how you can invest and grow your money. Now, three columns, one with annual returns, one with total returns, one with total return plus reinvestment. Now you know the difference between annual return and total return. Now let's see how you're going to multiply your money from $1,000 And first, I want us to get to 29,500 before we can scale up to $1 million. So we are starting off with $1,000. And why $1,000? The current price of SPY as of the time of recording, as I'm recording this video, is around $627. Okay. So I'm just taking a rough number, a good number that you can start with. That's why I'm saying $1,000. But remember, as I've told you, there's no minimum. If your broker can offer fractional shares, well and good. But let's just start with $1,000 so that we can make this calculation easy. Because 1,000 would get you like one share and some shares if you buy the money left over after getting one share. Now, your initial investment is going to be the $1,000. Then you're going to invest for 10 years. Okay. Now, we're going to use the growth rate of 10%. Now, this is annual return. Now, the price return you're going to get in 10 years, if you invest that $1,000 today, the price return, which excludes the dividends, will be only $2,594. Now, let's look what you'll get if you're going to calculate it using the total return. The formula you're using is down there, but you don't have to cram the formula because you're going to be using the calculators. So for the first column, all you did was invest the $1,000 to buy SPY, but you never invested anything else or even the dividends. Okay. Now we are getting to the second column where we have the total return. Now you have to note the difference. Okay. The growth rate in the first column is 10% per year. But when you get to the total return, you see it is 14.7% per year. So instead of taking your dividends in the second column for the total return, you're going to reinvest, okay? So the total return includes your dividends. If you invest $1,000 for 10 years, you've added nothing else, just the initial $1,000, you'll end up with $3,930. So let's see what we have in the third column. We are still so far from the $29,500. So this is where the magic happens because now you're going to make smart decisions with your money. We are going to jump from the $3,930 all the way to 29,500, and this is how you're going to do it. So we started with $1,000 and now we are working with a growth rate of 14.7% because it is the total return including your dividends. But the smart thing you're going to do, you are going to reinvest $100 every month. And I'm working with $100 because it is easy. At least if you have a budget and you have different sections where you can at least scale down and get $100, then this is the formula you're going to use. You're going to reinvest $100 every month for the next 10 years. But you started with $1,000. And at the end, your calculation is going to be $29,500. And all you need to do to scale up this amount to $1 million is to add how much you reinvest every month. So I'm going to do my calculations using a flat rate of 10% just to smooth out the good and the bad years. We all know that there will be bad years and there will be good years. Remember, at the start of this episode, I told you you have to know what action you need to take when the market is greedy and when the market is in fear. Okay? So let's use 10% because the market goes in cycles. There are times it will be up and there are times it will be down. It is just a cycle. If you want to get to the $1 million, you need to do $3,700 per month. Do you have that? $3,700 per month to invest? If not so, let's start with the 100. If you do the 100, at least you can get to 29. And what can you use $29,000 for? Would it help you do a down payment? Would it help you start a business? And if you can scale it up to even $400, you can get to 108K. What would you use it for? So it's all up to you. 10 years will go by either way. Remember, the stock market transfers money from the impatient to the patient.